Hi, I'm Jenny Brown and welcome to our weekly buy-to-let mortgage market update. I hope everybody's well. Today is the 2nd of December. We're out of lockdown where I live and where Mortgages for Business, both our offices are based actually. We're into tier 3 now, so this all continues for the time being. I hope everybody who is watching this is keeping really well. So lots of news for you today, and actually some really positive news, which is fantastic to be able to share. So first of all, in terms of what we have seen from lenders in the last week, first of all, I'm really delighted to say that Precise Mortgages have relaunched their refurbishment to let mortgage product. Now, this product was incredibly popular when it was around the first time pre-lockdown, so I'm expecting it to be incredibly popular this time around too. So how this works is essentially it's a mortgage product which is designed for those properties which are not quite lettable in their current condition. And what the lender will do is underwrite a bridging loan to acquire the property and then a pre-agreed mortgage to exit the bridging loan once the works are done. So what they will do is offer up 65% loan to value on the bridging element of the deal, and rates here start from 0.54% per month. And then what they will do is allow you to exit onto the term mortgage post works at 75% loan to value. So essentially you can recoup some of the equity in the property that you've generated from the refurbishment works that you have done. And the rates here start from 3.14%. So the really good thing about these products is that it gives you certainty that you can exit your bridge post-works. Secondly, it allows you to recoup some of the capital that you will have spent on the property and also gained with the works that you have done, up to 75% of open market value. And actually the pricing on the bridge, but also on the term rate, are very good. So it's a really nice proposition, one that, like I say, was incredibly popular the first time around. Now, a couple of things to be aware of. So first of all, the buy-to-let mortgage offer, so the bit that you would exit onto after you finish the works of the property, is only valid for 6 months from the date of valuation. So by virtue of the timings here, this is really a product which is designed for light refurbishments, so cosmetic things. I think realistically anything that's going to involve any kind of involved moving of walls and stuff will essentially potentially push the project out beyond the 6-month date. Now, this product is fine for individuals and limited companies. They can do it for normal sort of standard properties or HMOs as well. They're fine with landlords with large portfolios in the background. So it's a really good, well-rounded product. So we're really excited to see this come back to market. In other news, with lenders this week, we have seen the Skipton tinkering with their product range again. They like doing this. Nothing really exciting to report here. Some products have gone up slightly, some have come down. So I guess they're just readjusting their pricing model according to the cost of funds. We've seen platform home loans come back to the market. They're offering loans or mortgages of between £25,000 and £500,000. Their remortgage products do have free valuations and free legals, which in the more vanilla end of the market is not uncommon. And their rates start at 1.44%. Platform home loans, a bit like the Skipton and other lenders I'm about to refer to, are definitely more for those landlords with the smaller portfolios. They're not doing anything racy, but by virtue of that, it means you can get at rates like 1.44%, and they don't do any consumer buy-to-let mortgages. Now, consumer buy-to-let is something which causes a large amount of confusion amongst landlords and actually mortgage brokers to some extent as well, because it's one of those definitions where lenders take their own interpretation. But essentially, a consumer buy-to-let would be applied to any property which was not purchased or acquired with the sole intention of renting it out. So letting out of your own home, properties that you've inherited, as an example. Now, if the property or the mortgage is falling into the consumer buy-to-let category, it doesn't mean that you're going to be taking a different product or paying a higher interest rate. It simply means that the mortgage is classed as more being regulated, which means that the documentation that you need to be provided with in terms of quotations and stuff like this are slightly different to those that you would get if it was a non-consumer buy-to-let or non-regulated deal. So some lenders do these and some do not. So it's not really a big deal. It's just slightly frustrating because some lenders have different approaches to what falls into the consumer category. So as an example, some lenders would say, look, if you're doing putting a buy-to-let mortgage on the property which you have been living in, if you already have other buy-to-lets in the background, we wouldn't treat that as consumer buy-to-let, whereas other lenders would. So there you go. So a quick lesson on consumer buy-to-lets there, and platform don't do them. Okay, now we've also seen Metro Bank reduce their rental calculation on 5-year fixed rates. They're now working on 140% at 4.5%. So it's come down, and you can borrow slightly more per pound of rental income on their 5-year fixed rates than you could pre the changes. They've also increased their maximum age at maturity of the mortgage to 85. They're accepting applications where there are 4 applicants. What they do is accept applications from landlords with no more than 10 properties in the background. And they can also consider top slicing, which we'll go into another day. But some positive changes there from Metro Bank. Now, lastly, NatWest have changed their policy on accepting applications from those people who are on furlough. Now, what they're saying is if someone is on full furlough, then they will not accept an application from this person until they have returned to work and have 1 month's full salary credit into their bank account. If you are on partial furlough, they would accept the income that you're receiving on an earned basis, but disregard the furlough income. And I think really this is just symptomatic of how lenders are perceiving applications from those who are on furlough. I guess what's probably happened is they have been working on different models with regards to what was acceptable and what income they're actually using from furloughed applicants, and then only to find when they've gone back and done some latter checks that maybe things hadn't kind of panned out for their applicants in quite the way they'd planned. So there's a bit of this kind of changing going on in the market at the moment, which is actually very understandable as lenders really kind of start to understand the fallout of COVID and the position on employees or mortgage applicants' incomes once they have been on a furlough scheme. Okay, some good news for flat owners now. So owners of flats in building without cladding will no longer need an EWS1 form when it comes to selling or remortgaging their properties. And that's thanks to an agreement that was reached between the government, the Royal Institution of Chartered Surveyors, UK Finance and the Building Societies Association. And this is now part of a wider government-led solution to support those homeowners who have unsafe cladding on their buildings. But there is still obviously a lot more to do. But really great news. I know it's been a constant source of frustration for some of our clients where they're looking to refinance, buy properties, and even when it comes to selling things as well, where there is no cladding on the building yet they're still being asked to produce this report. The problem with the report is A, it's quite expensive, B, a lot of the freeholders are simply not prepared to obtain them because they see no need, and C, because the time frame to obtain these reports is very cumbersome. And leading actually nicely on from that, just additionally, the government has announced a £700,000 budget to train up more assessors, which will speed up the process where an EWS1 form is actually required. The training is going to be delivered by RICS from January, meaning there'll be 200 additional assessors qualified to carry out the EWS1 assessment within a month, 900 within 3 months and 2,000 within 6 months. That really should help expedite things. For those people who have got buildings where there is cladding in place, obviously there's still more work to do here, but this is a really positive step forward in terms of the situation with regards to those people who do have properties where there is no cladding, where they've been getting incredibly frustrated. Actually, the numbers, just to put this into context, this is expected to kind of free up 450,000 flat sales or remortgages for people going forward, so that should help alleviate some frustration from people. House building now. So Rishi Sunak has announced the launch of a new £7.1 billion National Home Building Fund, which was revealed in his spending review as part of the new National Infrastructure Strategy. So this will be based in the north of England and will be really there to help finance major new investment projects across this UK, starting from this spring. So last year, the government announced a target of building 1 million new homes over a 5-year period and pledged to increase house building levels to an average of 300,000 new build homes per year by the mid-2020s. Now, obviously, the pandemic will have made it a lot harder for these ambitions to have been achieved. But so it's really great to see the government really putting money into this to help drive up the number of new homes within the UK. And that's also going to be kind of supported and underpinned by the relaxation of some of the planning laws, which will help also the generation of more homes to be expedited going forwards. Now, for those of you who are hoping to secure a purchase before the stamp duty holiday ends, we've had a report published by a company called Searchflow, who have listed the turnaround times for the official searches from local authorities at the moment. And the variation is staggering. So there are local authorities who are turning these searches around really quickly. So Gateshead, 3 days, Guildford, 5 days, Exeter, 8 days, East Lindsey, 7 days, Brighton Hove, 4 days. So well done to these guys, because when you line them up to some of their counterparts, their figures look very, very good. So we had Thameside, West Lindsey, Wiltshire, West Berkshire, Stratford-upon-Avon and North Dorset, all with turnaround times above 40 days, with Hackney sitting at 181 days to return searches. So if you are planning to secure a property pre the stamp duty holiday, it's worth having a look at this data. If you can't find it, by going onto the Searchflow website, give us a call, we can go through it with you. But just to really understand how long these searches are taking to come back, because obviously that's going to really impact your ability to complete before the stamp duty deadline. Lastly to this week, I want to just have a quick run through of what's going on in the housing market at large. Obviously, it's running pretty hot at the moment. So where are we? So according to the nationwide house price index, annual house price growth accelerated from 5.8% in October to 6.5% in November, and that's the highest rate since January 2015. They've also gone on to say that house prices rose by 0.9% month on month in November after taking account of seasonal effects following a 0.8% rise in October. Now, additionally to that, and looking at demand, according to Zoopla, demand levels, they're expecting them to hold firm for the remainder of the year, with monthly sales completions suggesting the strongest run-up to Christmas for over a decade, and this is according to the latest research they've published. Now, what they're then saying is they're anticipating a further demand spike in January 2021 as buyers leave it late to enter the market in an attempt to beat the stamp duty holiday deadline. Those buyers probably want to go and check the Searchflow website with regards to local authority turnaround times on searches. Now, what Zoopla are saying is they're expecting the first quarter of 2021 to be very busy because of the reasons I've just said. But once the stamp duty holiday concludes at the end of March, they're anticipating a slowdown in sales completions, which will have a knock-on effect on transaction volumes in the second quarter of the year, which is expecting to run 20 to 30% below normal transaction levels as the stamp duty is reintroduced, before recovering slightly and running 10% below 2019 levels for the second half of the year. The influence of weakened demand in the stamp duty holiday ending is reflected in their house price inflation forecast for 2021, which they're projecting to the end of the year at 1% down 4% growth at the end of 2020. So it's expecting house price growth in 2021 to fall within a narrow range at country and regional level, from 1.75% in Scotland to 0.5% in the east of England and the northeast. So really what they're saying there, I think, is that overall in 2021, any kind of reductions in house prices, they're expecting them to recover, and then they're expecting to see a small amount of growth, which does vary depending on where the property is actually based. And that's it for me this week. Thank you for joining us. I hope we'll be seeing you at our MFB live event. Looking at the run-up of speakers, it's going to be really, really interesting, much more focused on kind of challenges landlords are facing and the wider landlord experience rather than just mortgages. So I think it will be time well spent if you do decide to join us. We'd love to see you there. As always, lots of information on our website, mortgagesforbusiness.co.uk, or do give us a call 0345 345 6788. We are a tier 3 business, but that doesn't mean we're closed for trading. Our doors are very much open. I think it's fair to say that we are seeing a huge number of applications coming through. We're very busy, so thank you for your support. But likewise, please don't think that just because we're in tier 3, our doors aren't open. They're very much open, and we'd love to hear from you. Until next week, guys, look after yourselves, and have a great weekend.